Welcome to the Deep Dive, where we cut through the noise and zero in on the essential insights. Today, we're looking deep into Jabil Inc., a major player in tech manufacturing. We're really focusing on their latest financials and, crucially, what's driving that stock price.
Yeah, we've gathered a stack of recent reports, earnings call details, analyst forecasts too. Our goal is to break down Jabil's latest results, get a handle on the market's take, and really pinpoint the role of their big push into AI.
Exactly. Our mission today is to help you, the informed learner, make sense of Jabil's recent wins, the forces behind them, and what it tells us about valuing companies in, well, these pretty dynamic markets. Okay, let's get into these numbers then. Jabil just dropped its third fiscal quarter 25 results, and honestly, the top-line figures look pretty impressive. What's the main headline here?
Well, what's really fascinating is that Jabil didn't just, meet expectations, they significantly beat them on both earnings and revenue. Their Q3 EPS, that's earnings per share, hit $2.55. That's more than 11% better than the $2.29 forecast.
Wow.
And revenue, $7.8 billion. That smashed the $7.3 billion expectation by almost 11% too, and it's a solid 16% jump year over year.
So this isn't just scraping by. It sounds like a genuinely strong quarter. What does that tell us, especially given, the wider economic climate can still be a bit tricky?
Precisely. And it's not a one-off. This actually continues a trend for Jabil of beating predictions, which says a lot about how well they're running things, their operational execution. They also posted core operating income of $420 million. That came with a healthy 5.4% margin. Stepping back, it suggests Jabil is navigating this dynamic environment really effectively, especially when you consider some headwinds they are facing in certain areas, like, say, EVs and renewables, which maybe we can touch on later.
Right.
Performance like this, it often signals strong fundamentals and good management to the market. That translates into investor confidence, and, well, usually stock performance follows.
Okay, beyond just the headline numbers, what's the engine really powering these results? I get the feeling a huge part of the story is Jabil's focus on AI.
Absolutely. That is precisely where the big growth story is. They've revised their full year 2025 revenue forecast upwards to, get this, $29 billion. And that's largely because of the AI emphasis. Jabil's now looking at around $8.5 billion in AI-related revenue for fiscal 25. That's an annual jump of over 50%. Just massive growth from that one area.
Over 50%.
Yeah.
Just from AI. That's incredible. What does that kind of acceleration mean for their capacity? How are they planning to actually meet that kind of demand?
Well, their CEO, Mike Dastoor, put it pretty plainly. He said demand for AI hardware is not slowing down. If anything, it's accelerating, which naturally leads to the question, how are they gearing up for it? Well, Jabil's putting a substantial $500 million into a new facility in the southeastern U.S. It's specifically for boosting AI data center infrastructure. Think high-complexity AI racks, the increased power needs, liquid cooling, all that critical stuff. This site should be up and running by mid-2026. And what's really interesting, especially for you as a learner, is they're saying this big investment won't change their usual annual CapEx outlook. They expect to stay within that 1.5% to 2% of revenue range.
Really? So significant investment, but no change to the overall CapEx percentage. That suggests some pretty smart financial management, maybe reallocating things.
Exactly. It points to efficient capital deployment, strong financial discipline, even while they're expanding aggressively.
So they're not just waiting for demand. They're actively building for it and doing it without blowing up their spending plans. Which specific bits of the AI world are driving this growth for them?
It's mainly coming from their intelligent infrastructure segment. That saw revenue up about 51% year on year in Q3. This covers things like, complex server and rack integration, advanced networking gear, innovative power and cooling systems. Basically, they're building the physical backbone for the whole AI revolution. They're also seeing really strong growth in photonics that's using light for computing and data transfer. They think that could hit maybe $1 billion in revenue beyond 2026. It really shows how Jabil is using its deep engineering and design skills to become a key partner for the hyperscalers.
But the big cloud guys, right? Amazon, Google, Microsoft.
Exactly. Those companies need specialized, high-performance hardware for their AI operations, and Jabil's positioning itself to deliver that. It's a major differentiator for them.
Okay, that's a compelling story. Growth fueled by a smart pivot into AI. So with financials this strong and such a clear growth path, you'd think the stock price would just, shoot up and stay there. But when we look at the market reactions of what analysts are saying, well, it seems there are some really different takes out there. Let's dig into the stock performance itself.
Right. The immediate reaction after the earnings announcement was very positive, just as you'd expect. The shares gapped up before the market even opened on Tuesday, June 17th. The stock had closed around $180, opened higher near $185, and then kept climbing. It gained over 10% in pre-market trading, hitting a range around $199 to $200. That definitely showed strong short-term confidence.
Okay, a nice immediate jump.
And the stock's done well overall recently, up about 35% over the last 6 months. But Investing Pro's technical indicators were suggesting it was maybe getting into overbought territory. And it's trading at a pretty high PE ratio, 42.8 times earnings. Now, a high PE like that often means investors expect strong growth.
Right, they're paying a premium for future earnings.
Exactly. But it also suggests those high expectations might already be fully priced into the stock.
Okay, so initial excitement, but maybe some technical flags waving. But you mentioned diverging views. Where does the caution come in?
Yeah, this is where it gets really interesting for you, the listener, because it shows how different ways of looking at a company can lead to, well, very different outlooks. Take Wall Street analysts. Their average one-year price target is actually $179.14.
Lower than where it's trading now.
Yes, quite a bit lower than the recent $200 level. That average target suggests a potential downside around 10.5%, even though the overall consensus rating from analysts is still outperform. There's a range, of course, high estimate around 206 eyes low at $155, but the average is pointing down.
Okay. And wasn't there another analysis from Guru Focus that was even more bearish?
Yes, quite a stark contrast there. Guru Focus calculates what they call a GF value, aiming for a fair value based on historical multiples and future business estimates. Their estimate for Jabil 1 year out is just $117.35.
Wow, that's way down.
It projects a potential downside of over 41% from the current price. Now, GF value often takes a more fundamental, longer-term view, trying to filter out maybe some of the short-term market noise or momentum.
So it forces you to think, is the market caught up in the AI hype right now? Or is there a fundamental value mismatch that models like GF value are picking up on?
That's precisely the question it raises for you. Are investors paying too much for the near-term AI story, or are these longer-term models maybe missing the scale of the transformation Jabil is undergoing? It makes you question if that AI premium is justified fundamentally.
And just to add another layer of complexity, there was that A-Invest article with another set of numbers and a very different recommendation, right?
Exactly. And timing is key here. That A-Invest report came out on June 15th, which was before these latest Q3 earnings were released. Back then, they noted Jabil traded at a much lower PE, around 14 times, well below the sector average at the time. Their model suggested a 26% upside, leading to a strong buy call with a target of $85, up from around $67 where it was trading then.
So completely different picture based on older data and maybe a different model.
Precisely. And it highlights something crucial for you. How much fresh data, like these Q3 results, can change the picture. And how different valuation methods, different time frames, they all play a role. It really makes you ask, how do you weigh these conflicting signals? Which data is most relevant now? It's a reminder that you need to look at multiple sources and understand their context.
Absolutely. Okay, so AI is clearly huge, but Jabil isn't just an AI company, it's diversified. What's happening in their other business areas, and how are they balancing all this financially?
That's a great point. Their overall results really do underscore the value of that diversification. While intelligent infrastructure is booming thanks to AI, other parts of the business show more mixed results. You've got regulated industries that includes healthcare, EVs, renewables, and then connected living and digital commerce, which covers consumer stuff and warehouse automation. They mentioned that the EV and renewable segments are still a bit soft. That's partly due to wider economic factors, maybe some temporary oversupply in solar components, things like that.
So those areas are dragging a bit.
They're facing headwinds, yes. But the fact that Jabil's overall results are so strong despite these pressures actually highlights their resilience. And CEO Mike Dastoor really emphasized their ability to offer diverse, resilient, and localized manufacturing solutions. He specifically called out their large U.S. footprint as a significant competitive advantage, especially with, current geopolitical tensions and supply chain concerns.
Right. Having production closer to home is becoming more important. So that diversity helps cushion bumps in specific sectors. How are they managing the money side of things, especially with that big new AI investment?
They're generating really strong free cash flow. They reaffirmed their guidance. They expect over $1.2 billion for the full fiscal year 2025.
That's a lot of cash.
It is, and it gives them room for aggressive capital allocation. They bought back $339 million worth of their own shares just in Q3. They're also on track to finish their current $1 billion share repurchase plan in Q4.
And they've committed to returning a lot of that free cash flow to shareholders, haven't they?
Yes, 80% through buybacks. Which is a pretty powerful signal for management, wouldn't you say? It suggests they believe their own stock is undervalued, or at least a very good investment.
It certainly signals confidence. What about debt?
Very manageable. Their debt-to-core EBITDA ratio is only about 1.4 times. That's quite low, very healthy, and gives them a lot of financial flexibility for future moves. And historically, their acquisition strategy hasn't been about huge, risky mergers. They tend to do smaller, tuck-in acquisitions. Basically buying smaller companies that add specific capabilities like in silicon photonics or drug-filling tech things that enhance what they already do or open up adjacent markets, rather than trying to completely transform the company overnight with a massive deal. It's a more measured approach to growth.
What an insightful deep dive into Jabil's whole picture. We've seen a company hitting it big with AI, showing impressive results, but also navigating slower patches in other areas and managing his finances really smartly, investing for growth, but also returning a ton of cash to shareholders.
Indeed. Their ability to post strong earnings, even with those mixed conditions across different segments, combined with those strategic AI bets and the robust free cash flow, it really paints a picture of strong operational discipline and a remarkable ability to adapt.
So wrapping up, what does this all mean for you?
Well, beyond the numbers and the conflicting stock forecasts, maybe think about strategic agility, how a company's ability to pivot, to lean into high growth areas like AI while staying resilient and managing its capital well in other parts of the business, how that impacts its long-term health and ultimately its value. And it makes you wonder what other, maybe more traditional manufacturing firms could adopt a similar adaptive strategy. How might they leverage new tech, and what could that mean for the future of global supply chains? Definitely something to mull over until our next deep dive.